Hey, so today I'm going to take a closer look at some ways to value companies that might not even be profitable yet. Look, I'll tell you now, this is not my area of expertise and it is not easy to do accurately, but this is how I would approach a company that might have a lot of potential. Okay, for those of you who are new to my channel, well, welcome aboard. Today is a really challenging video to make, but I think it's important to address as so many people are interested in high-flying growth stocks. 90% of all investors lose money. So I hope to help some people understand what it is they're actually buying. So I plan to go through a few things that are necessary in determining the potential value of a high-flying growth stock. Okay, the first thing we need to look for is we need to make sure they have at least 5 years of information. Now that doesn't necessarily mean the company had to IPO to the public at least 5 years ago. For example, Roblox. Roblox is a gaming platform that has like 32 million active daily users, generates a lot of cash flow, and has been around since 2004. But just recently, on March 10th, 2021, the company first went public. Now, we can actually get historical data on Roblox by just going to the investor area on their website and looking through what's called a prospectus. A prospectus is a document that the company puts together prior to listing their shares to the public. It's like a sales pitch to the world on why people should buy their shares. So we can go back through this past data and understand what has been happening with Roblox. This is unbelievably important as we can see how they are developing their business and how it has been growing in the past. Now, a company that isn't profitable doesn't sound like a good investment, and generally that would be true. But if we think about Amazon and how many years they spent unprofitable, well, that was smart of them as they didn't want to pay taxes and instead spent many years just plowing money into the expansion activities and growing their empire. So what we need to do is actually look for what we call good growth, growth that actually adds value to the business. For example, sales growth is a great metric, but we need to make sure that shares outstanding isn't growing at the same time. See, if the revenue doubles and shares outstanding doubles, well, that's actually no value added. Also in saying that, if sales are growing, but it's because they have been lowering their prices and therefore the return on equity is getting worse, then that is not good growth. So when looking at growth, don't just look at revenue or sales growth. Look, I would look at sales growth, but I want to see it with the shares outstanding and compare it to the return on equity. Plus, we're going to look at customer growth, customer retention metrics, and average spend per customer. If these areas are all positively growing, then I would take an average growth rate of these things for the past 5 years to get a good idea for the growth rate of the company. So going back to Roblox for an example, well, it has doubled from 2020 from 2019. But prior to that, it hadn't grown anywhere near as fast. So using 100% growth rate is actually a bad idea. It's more like 30% when we average it out over past data. All right, so nothing about these types of investments is an exact science. This is more about your thoughts about the industry they are in and the size of the market the company can expand into. For example, a business like Chipotle. See, 10 years ago, they had a few stores that were very popular. They were highly profitable stores too. What was stopping them from expanding through America and throughout the world? Well, not much, I guess just time. Of course, they were not going to be able to be a global success immediately, but store by store, their invested capital was going to compound. They had already proved it would work in 50 stores, so why not 5,000 stores? And we could easily see other examples of this with Subway, McDonald's, KFC, all spreading throughout the world, so why not Chipotle? This is the type of obvious conclusions we want to find in growth stocks. So think about this when predicting future value. If it isn't obvious, I would forget about the company. Okay, a growth company that you're looking at is probably not going to be profitable from an earnings point of view, but it might be free cash flow positive. See, free cash flow, in my opinion, is more important than earnings per share because free cash flow is a number that represents what the cash flow is available to all the stakeholders of the business. See, earnings per share, or EPS, can be low or negative because management are spending a lot of money on expansion plans, just like Amazon did. And we can use free cash flow and the growth rates to project out into the future to help us value the company. So, in summary, free cash flow, more important than earnings per share. And at the end of the day, that free cash flow is what we want to see growing and compounding, as this is essentially our stake in the business. Okay, you hear me talk about return on invested capital quite a lot on this channel because it is really important. Return on invested capital is the ability for the business to use this cash flow to invest into the growth of the business and then earn more money the following year. It's where we want to see $100 of free cash flow turn into 120 and then 144 and 172 and 207 and so on. So if you can't find the information for the above 5 points, then I wouldn't bother trying to value the company. Without this critical information, I think you're speculating, and that isn't investing, and it's not how good investors would invest. Even the more impressive investment businesses like ARK Invest and Social Capital and pretty much most of the successful venture capital firms, well, they look at these 5 areas as important for their investments. So for me personally, I don't go any further unless I can answer those above points really clearly. All right, now this is a strategy that I have developed and been using as a guide for my valuations. Price to free cash flow is the normal valuation method that has been used for decades to compare the stock price to the free cash flow the business has. Now, like I've said before, free cash flow is more important than earnings per share, in my opinion. Then I add a growth element to this price to free cash flow. So what I do first is I get my estimated growth rate based on the historical data, pretty much what we did from points 1 to 5 earlier. Now, I normally give myself a bit of a range here. So for Roblox, I think it could grow at 30% per annum moving forward, but it is possible that they have some issues. For example, maybe Apple bans Roblox from their iOS devices because Roblox has its own in-game currency and its own in-app universe. Maybe Apple has a problem with that. If they do, well, that could really hurt Roblox. So maybe 30% is my optimistic side. Maybe a middle ground is like 15%. And in a terrible case scenario, the whole thing falls apart and goes to 0. So let's just use 30% as the growth rate. And I'd want to see a price to free cash flow under 40, according to my table. And this would give me a fair valuation range for Roblox. Now at 15% growth rate, under about a 20 price to free cash flow would be a good valuation. These are of course ballpark estimates. Growing companies are just really difficult to value, but this at least helps us work out a rough price. This doesn't factor in debt or cash or share dilutions or many other things. So look, don't use this in isolation, that would be gambling. Now, when I'm actually making this video, Roblox price to free cash flow is like, I think it's over 100, so that's just silly overpriced. The price to sales ratio shows how much the market values every dollar of the company's sales. Now, this ratio can be effective in valuing growth stocks that have yet to turn profit. For example, if a company isn't earning a profit yet, we can look at the price to sales ratio to determine whether the stock is undervalued or overvalued. And if the price to sales ratio is lower than comparable companies in the same industry that are profitable, then that is a sign of undervaluation. So let's say the company has a price to sales of 1.7, while its peers average a 3 for price to sales. If the company can continue its growth, its share price could be expected to move up to the industry average. Again, this doesn't factor in debt or cash or share dilution or lots of other things, so don't use this in isolation. Okay, the PEG ratio. Now this one is really easy. It is like the PE ratio, which is price compared to its earnings, but we also factor in growth rates. Amazon, for example, has a PE ratio of 70, which means it will take 70 years to get enough earnings to cover the share price. But that assumes no growth. See, Amazon's PEG ratio is actually a 1.7. Peter Lynch would say anything above a 1 is a little bit overvalued, anything over 2 is fairly overvalued, but anything under a 1 is undervalued. So 1.7 is a little overvalued, but not crazy overvalued. Now this only works with companies making a profitable earnings number though, so I can't use this one for Roblox. Just to compare, Tesla's PEG ratio at the moment is a 6.45. which is crazy high, and that factors in the expected growth rate of 32% per year for the next 5 years. Then we look at Dropbox, which is like a 1.1 at the current price of about $26. This works nicely with my buy price of about $20. At $20, we were well under 1 when looking at the PEG ratio. Therefore, it could be considered undervalued at under 1. Oh, and just a quick tip here, something to be really careful about here is that this number varies widely from website to website. So just double check a few. And better yet, we should calculate it ourselves. So to calculate this yourself, you get the trailing 12 months earnings per share. So Amazon's earnings per share is $41.83 for the trailing 12 months. Now, we divide that by your own growth rate estimate for the next 5 years. So I think about 25%. So 41.83 divided by 25 is a 1.67 PEG. So it is always best to calculate this one yourself and not use websites' PEG ratios. Again, like methods 1 and 2, this doesn't factor in debt or cash or share dilution or anything like that. So look, don't use this in isolation. These methods of valuation work for most investments, not just growth companies. They are helpful to get a ballpark figure of fair value too. I think researching a company requires a lot more investigation than just these things I covered today. I have a big checklist which I go through one by one to evaluate a company. And something I haven't even talked about is what's the management team like running this business, because that's pretty critical. A fast-growing company with a crazy CEO won't really help me build my long-term wealth reliably. And regarding companies like Roblox, I haven't done enough research into the management team to understand how good they are. Plus, I generally avoid companies that are just doing an IPO because often there is just way too much hype around the company. But if you are wanting to investigate a company that is about to IPO or recently IPO'd, then I suggest going through the points in this video to make sure you can get a ballpark valuation on the company. I hope you enjoyed this. Thanks for staying to the end of the video, and I will see you next time.